because it's one of the markets which provides growth visibility. And maybe everyone, even the foreign investors are waiting for a price points at which maybe they feel it is reasonable. So I think this market from that perspective becomes more a buy on dips type kind of a market till the time this whole structural thesis of growth doesn't break down. As I said, growth remains an important parameter. So overall valuations, as I said, may look reasonable, but it is a mix of each of the segments. Let me come into the small and mid cap valuations. This slide should have been the last slide as far as the small and mid cap section is concerned, but I thought of taking it in the front just to maybe convey the most important message, which is on the valuation side and how to deal with this high valuation. So we are now seeing the mid caps is at the highest point when we compare it versus the Nifty in terms of price to book, and the small cap is also on the high, but it has seen some marginal maybe correction from the top. So I think that is the valuation picture. But again, let me again warn you that this is for the index. Different segments will have different ball game altogether. Uh, so I think that is the broad discussion around the overall corporate sector. This is my favorite slide, which speaks about the long-term return metrics of the markets. And as again, this is a very busy slide, but let me just decompose it for you guys. The top chart shows how much return the market has generated versus the earnings growth, and this is for Sensex, which we have done. So broadly, if you look at the 30 years history, the market returns have generally changed the kind of earnings which the corporates has delivered. So the important point to focus is that and last 30 years, let's say the markets could have delivered 9 odd percent. The earnings have CAGRed at 11 odd percent, so which is very close. And when you look at the chart down, we see that even within the the earnings trend, which looks like a linear trend, there is a lot of cyclicality. There are periods where earnings itself slows down. Like for example, FY09 to FY18, the earnings growth CAGR was just about 5%, and now for the last 3 years, it has been over 20 odd percent. So I would say that the earnings trajectory itself is lumpy in nature, and one has to recognize where in the cycle are we. And again, maybe just to sort of get a slightly high level perspective as to how we are thinking about the earnings momentum. Um, I think the question for us to solve is that can corporate India grow at 11 to 12% rate of growth over the long term? And are there ingredients present? So, when we look at the changes which has happened over the last few years, I think there is a massive support coming out from the government. The government has been talking about their Vision 2047, where they are talking of, getting at a number 2 position in terms of the economy, talking of per capita growing at almost 10x, focus on manufacturing. I think these are all segments which were neglected in the past, and the government has actually hit the right node is what I can say. The other important aspect is that both with the public sector and the private sector, we are seeing more broad-based capex, which is happening, railways, defense, power, roads, ports, water. On the private side, we have across the manufacturing, government is supporting the manufacturing, factory buildings, data center. So there's a whole host of segments which are actually supporting this growth. And hence, this becomes a more broad-based growth format for the Indian economy, and which is where the interesting part about the small and mid caps comes about, because I will showcase in the slides ahead that there are many segments which otherwise it is very difficult to capture in the large cap names, but many segments which are seeing decent growth outlook, they are only part and parcel of the small and mid cap, and hence why it becomes relevant from that perspective. The other important aspect is that if we look at on the right hand side, a lot of the sectors which the government has focused on, there has been a very significant rise in the capex the government planned, water, railways, road, defense. And the overall capital expenditure to GDP, after seeing a stagnation since 2010 to 2020, we are again seeing an up move. Now, there is also worry about the private sector investments. Let me sort of give again the important data point. So the chart below is showcasing the private sector investment which has happened, and 24 is on the basis of again these top 500 companies which has actually added to the gross block. If you see that over the last since 2011, the average gross block addition used to be in that 6 lakh crore range. Last year it has been 10 lakh crore range, and we've still not seen many segments of the corporates coming out and spending in terms of the capex, but there are few like oil and gas, energy, steel, cement. These are the ones which are spending on the corporate side a lot more. But as the growth sort of picks up, we will also have some of the private sector coming up in terms of the investment. Um, this is again a very important slide just to think from the next maybe few years perspective. This is basically breaking down the GDP into two component. One is the consumption side, which is the orange line, and the blue bar is the capex line. So blue bar is represented on the left hand side, and the orange bar, which is the consumption, is represented on the right hand side. So if you see the consumption generally accounts for between 55 to 60% of your overall GDP, and the capital formation is the balance. And if you look at the data points since 2002, we had this good phase of economic expansion, capital formation, which was taking place in 2002 to 2010. And that was a time when consumption was a bit subdued. And then we had a phase where investment actually took a backseat, 2012 to 2020. And it was stagnating, which I just showcased in the chart before. And at that time, the consumption actually gradually increased. Again, in this last 3 years, we are seeing that the capex cycle is again sort of picked up significantly, and the consumption is sort of slowing down. And this slowing in the consumption is again to do with what I mentioned, that the bottom end of the pyramid, or the entry level or the low income group, actually not participating in this consumption spend. The my sense is that as and we will see this in the upcoming budget. I think the recognition or the realization is there from the government side that the welfare spend has not matched in the past few years, and there's a possibility that some amount of welfare spend takes place, which basically means that there could be some boost which could be given to the consumption. And capex momentum is likely to continue, may not be at the same pace as at which we saw in the last 3 4 years, but it could still be in the range of 10 to 12%, which I think is a good number to sort of think about. So our sense is that over the next 1 year or so, this whole texture of the economy could change, where the consumption could sort of gradually pick up, and we'll have investment also sort of doing reasonably well. And hence a combination of two is something which I believe we will see a better balance going forward. So that's the other aspect. And then this is more from the consumption side. We are having the benefit of very good strong demographics in our favor. The upper layer of the middle income and the high income people, that number is growing gradually, and it will keep growing as the people start earning more. There is some bit of again a hurdle which we have it, where we are seeing that IT sector is currently slow, but my sense is that over the next decade or so, this trend should continue, and which will aid in premiumization, which will aid in organized spending going up, and it will aid in the overall consumption growth. So I think as a philosophy, while we have seen that the consumption trends were slow, but we are not really very negative on the consumption part. We believe that we still have the metrics present for the and it is just that as the balance becomes more even, I think the consumption should also sort of see an up move. And as far as our portfolios are concerned, we are incrementally looking at gradually building up some of the consumer discretionary businesses into our portfolios. So I think to just summarize, maybe from what I discussed is that as investors, one should be thinking of whether can we achieve 12, 13% CAGR, earnings CAGR over a decade is what is going to determine the direction of the market. Maybe we could have one a year or maybe few quarters of consolidation in the market given the slowdown which I spoke about. But I think eventually these are all cycles and we should sort of catch up. What are the factors in our favor? I think government's pro-growth stance, our balance sheets are very strong. Uh, uh, the demographics are in our favor. Private sector participation should improve, and consumption, as I said, is improving. And what are the factors which one has to be watchful? High interest rate in the economy generally leads to slowdown. Any factor which leads to the capex momentum being hurt is something which one needs to be watchful. And anyways, I have given the insights into the market valuations, so which is something which we have to be careful about. So, I just thought of getting that context in mind before discussing the small and mid cap, because I felt that it was important to sort of capture our thoughts, and which is what is also getting reflected in our stance of managing capital. Let me just sort of indicate to you at this juncture, as we were navigating a very volatile and a very uncertain equity environment over the last 2, 3 years. We had seen that because of this relentless flow of money and a linear bull market, there is a good amount of dilution in the quality which was also witnessed, and where low ROE businesses were actually doing very well. I think we are seeing that stance, changing now, and that is also a reflection of uh, um, the quality portfolio which we run, where we are seeing the comeback after a good period of 2.5 years of decent underperformance. So again, my sense is that, as I say, that these are all cyclicals. We'll have periods of exuberance and then periods of rationality. I think we are getting into period of rationality. From my side, I just want to maybe highlight to the investors that it is very important to stick to quality, especially at this point in time when valuations are high. And still, one would want to capture this good decadal growth opportunity which is available as far as India is concerned. The best way to sort of focus on is to stick to quality, and I think to sort of reduce the chance of going wrong just in case any of the matrix derails. So before getting into the small and mid cap, let me just maybe for the sake of understanding highlight that when we talk of mid and small caps, for mid caps we are talking of companies which are between 30,000 crore or 27,000 crore to 80,000 crore in terms of market capitalization. So these are large companies now. These are when we say mid cap, they are not small companies in terms of market capitalization. They are really large companies. A lot of these companies are, generally having their turnovers in the range of 15 to 20,000 crore, which is again a high number to sort of focus on. So it is not necessarily small companies we are dealing with when we are talking of mid cap companies, and same is the case with in case of the small cap businesses, where we are talking of companies which are less than 27,000 crore in terms of the market capitalization. So the size and scale of companies have over a period gone up. The important aspect to focus on is the opportunity which is available as far as the mid and small caps are concerned. These are the stocks which we actually own in the portfolio. Now, what I wanted to make you realize is that there are many segments which are large segments, and they have big opportunities for growth. For example, specialty chemical. For example, fertilizer. For example, tile building material as a company. For example, cable manufacturer. I mean, these are to us, these are large opportunities where these companies over the next decade will see good growth coming through. But the only way to play some of these is by way of by way of having to invest into mid caps, because the largest company in each of these sector is a mid cap company. And if one has to think about playing the largest, let's say, agri-based player, there are no identifiable large cap one who can indirectly play through buying M&M, because they have a tractor play, but there's no direct way to play. So what I'm saying is that these are large segments, but there is the way to play is through the mid cap as a category. And as I said, each of them does have the decent opportunity to sort of keep growing over the next decade or so. Same is the case with small cap companies. There are a lot of these companies are leading companies in their own segment. Be it, let's say, the sugar manufacturing companies, seamless stainless tube manufacturing companies, largest furniture player, largest travel company, luggage company. So a lot of these companies are part of your small cap, and as I said that for each of them you have decent opportunities which are available, and hence the whole idea of showcasing these names here is the fact that when we talk of small cap companies, the biggest risk in our minds is that is there a risk of losing capital? But when we deal with the high quality businesses, high quality companies, companies with proven management, companies with great track record, companies with very strong moats which allows them to be unique, which allows them to be leading companies, which allows them to be leaders in their own respective segment, there could be periods of underperformance because of business cycle, but the risk of losing capital over the long cycle is low, and which is where our framework of selecting companies becomes important. And I'm going to dwell into the framework and what we sort of focus on, which gives us confidence and conviction that while we may go through a period of slow growth, but we are reducing the chance of sort of losing capital on these names. The philosophy is very simple. We are bottom up. We have a bottom up approach of selecting companies. We look for businesses with large opportunity. And when I said that, agri as a market or building material as a market, these are large opportunities for us to sort of focus on. We look for sustainable moats, which means that what is the unique characteristics of the company which we have to sort of follow. And does the company have those unique strength which will allow them to remain leaders going forward as well. Here, I think an important aspect to notice is, we've mentioned sustainable modes. The reason for this is that we all know that a lot of these companies which have achieved leadership profile is because of the unique strength they have. The strength could be lowest cost, the strength could be best distribution, the strength could be innovation, strength could be brand. But what is happening is that a lot of these modes are also getting disrupted in current environment. There is a disruption which is happening because of either technology, or disruption is happening because of the government regulation. So we have to be very careful around these disruptions, and we have to keep measuring whether the modes the company enjoy are more sustainable in nature, or they could sort of fall through, and these companies will lose those modes. So we'll keep looking for sustainable modes. One of the important criteria for us is to focus on growth, and the other is ROEs, because we believe that businesses which are not able to cover their cost of capital are going to destroy wealth over a period of time, and hence the focus has been to have companies with decent ROEs, and we have our own metrics. We like to have companies above 16% ROEs. Um, beyond these parameters, we also look for the quality of management, their passion, their leadership profile, their capital allocation decision. And I think that this is to us a very important aspect as far as the stock selection is concerned. We definitely are not supportive of companies which either have any governance issues, or where the valuations rise to extremely high level, and the business cycle also reach a high point. So those is where we try to sort of sell the position down. Some of the quantitative metrics which we have followed is, as I mentioned, ROEs, growth, the balance sheet, debt profile, the earnings variability. I mean, highly cyclical businesses, something which we'll try and avoid. Businesses which generate good cash flows, have a decent working capital management, and companies which are again high on governance, tax-paying companies. So these are some of the metrics which we follow, and what we avoid is also important, because not only earning money but avoiding mistakes and avoiding big capital erosion is again critical. So companies with governance issues or capital misallocation, regulatory risk is something we have sort of taken care of. To carry out this exercise in a lot more detail, we also have one of the analysts who is doing forensic research for us, who highlights if there are any accounting or any governance issues any of these companies has. I mean, then it is red flag to us, and we are able to sort of then react quickly if we find any of these things getting into our portfolios. So I think we've tried to create strong boundaries to sort of avoid as well, which is also going to be relevant from the long-term wealth creation perspective. Now, why is it that we are so focused on following this framework? Again, going back in history, we've done this analysis for around 350 odd companies. And we looked at the long-term wealth creation of these data set, and we looked at companies which in the peak of 2008 till let's say 2022, what has been the level of change in the market capitalization or the average price appreciation, and generally the two important metrics, growth and ROEs. How has these companies on an average fared in terms of the growth and ROEs? So if we look at the let's say the row number 2, there have been almost about 38 companies during this period which has seen negative returns. And the important observation here is that the profit growth was negative, and the average ROEs were very poor. Likewise, if we look at the row number 4, a lot of the small cap companies actually, row number 3, 28 companies started as small cap, they became large and mid cap companies with a 25% price appreciation CAGR over this period, and profit pool increase of 15% and average ROE of 22%. So I think this is in a way proven that the stock price will generally try and follow your long-term metrics of growth and ROE, and which is what our focus has been. As far as this framework is concerned, when we think of this is the mid-cap fund data points, our average ROE for the mid-cap fund is generally in between 18 and 19%. The growth which we aim for is above 13%. So our portfolio sort of gives us comfort that it has shown above 17-18% kind of growth. These are typically cash flow generating companies, low leverage, and a good stability of earnings. Same is the case with our small cap fund, where we have seen that the metrics of our portfolios are pretty strong. It's almost 45 minutes, but let me just cover 2 more slides, and then I will end there, and then maybe invite queries from your side. So one is what has been the differentiating factor for us versus maybe other funds. I think some of you who might have heard us many times in the past, we've always focused on having low turnover in our portfolios, because the fact is that we try to buy good businesses and not trade stock prices. Stock prices may be short-term phenomenon, but if you buy good businesses over long term, they tend to deliver decent outperformance. So on an average, our turnover ratios have tended to remain low. And also while I spoke a lot about the good and some bit of negative aspect of investing into mid and small cap, but one more let's say point which I wanted to highlight, which investors should be aware about when one is investing into the small and mid caps, is the fact that the journey is never linear journey, and the journey is actually is a mix of good and bad experience over a period of time. The category generates decent returns. So this is our DSP small cap fund. If you look at the returns since inception, has showcased quite satisfactory returns as compared to the benchmark as well. But the journey was not linear. So, at a time when investors might have invested in the 2008 peak, it took almost 6 years for 7 years for the returns to actually come by, and it was a long waiting period. Same is the case with 2017, when we had shut the fund for flows. It took almost 3.5 years, where investors saw zero return, and then after that it was a massive one-sided move. So I think our guidance to investors has always been that when one is looking at this category, the category has decent potential, but one should be open to have a very long-term horizon when one is thinking of this category, because there could be period where the market is going through consolidation. Uh, the businesses are going through consolidation, and it is possible that it could become very frustrating where returns are not coming by. And I think this is something which an investors need to be aware about. But does that make the case negative for the category? I would say no. And also one more insight, because I'm short of time, I'm just skipping few slides. One more slide, we did an analysis of our DSP small cap fund just to see the 7 year returns from different points in the market, and if one is doing an SIP. So, in case of the DSP small cap fund, if an investor uh, starts an investment through SIP when the BSE small cap index has fallen by 20% or more, let's say the return average is showcased in the first line. Then the third line is the case where you are at the top of the price point as far as the BSE small cap is concerned, and investment is done through SIP. That has created an outcome which is even better than when one is investing at the low point, which means that when you start investing at a high point, coming the money getting invested through SIP makes a lot of sense, because you are just in case if the markets were to sort of see a step down, then there is an averaging down which is taking place, and that allows the investors to maybe average out better. So I think that is an important highlight sort of for all the investors. And with that, let me sort of end my discussion here and invite more questions. I just thought I should provide uh, a comprehensive insight into the markets, corporate sector, small and mid cap, and also highlight what are the potential aspects which investors should be mindful about. Thank you so much.
Thanks a lot, Vineet. Thanks a lot for this insightful presentation and a lot of data points. We have quite a few questions pouring in. So I will start with one of the most immediate question, which is flashing through across a lot of questions which have come in. Mid-cap fund, DSP, been a stellar performer for a very long time. Last 3 years has been a rough patch, but last few months showing a sign of upheaval. And will this upheaval will be consistent enough for us to look back at it? Your thoughts on it?
So, see, this the whole performance cycle is also actually related to the framework which we have followed. And even during the underperformance, the whole ability to sort of endure the pain and still maybe stick to the discipline is something which I would say we have showcased that. Um, just like all my investors who have remained invested during the last 3 years and has seen underperformance and were disappointed. Believe in me, I was also going through the same amount of disappointment and same amount of frustration, but not diluting this whole philosophy, or not sort of diluting on quality, which is what we have stuck to. And you can look through the portfolio. I think none of the companies, when one looks through, one will be able to sort of figure out any issues around the quality of businesses. It is just that at certain points in time there are businesses which goes through low cycle, and unfortunately, a few of our categories like healthcare, few of the categories like maybe chemicals to some extent, they went through a low cycle at a time when the markets was very heated up. So we got caught on both ends in terms of the portfolio mix, which was slightly adverse, and hence which created a huge gap. So when the huge gaps are created, it also takes time to recover. So all through this last 2 to 3 years, there is a lot of introspection. There is a lot of assessment of our strategy. Are we getting any of the aspects wrong? So we are very open about also admitting our mistakes and trying to figure out any changes need to be done. We've carried out a few changes in terms of the portfolio matrix. We've diversified the portfolio a bit more, again, not letting down on the framework. And We've also made some tilts around some of the segments, which has actually allowed us to come back. And as I said, the most important point is we are witnessing the quality as a strategy sort of again regaining strength. My judgment is that the next few years, again, the quality should become an important factor, because, anyways, you've already seen a lot of froth in the market, which I anyways showed. So it is good to, be aligned to a high quality, good quality portfolio over the next 2 to 3 years, where at least the assurance of the businesses delivering reasonable returns is high, and one is not, let's say, risking at a point in time where the valuations are at the high point, just in case there are any risks to the valuations, then that will also mean that this kind of portfolio outperforms. So, to maybe answer your question, my judgment is that we saw a good recovery, and hopefully, our whole effort is to keep improving on a daily basis.
Thanks, Vineet. The next question is, does staggered investing in suggested in mid and small cap at this level, or should someone wait for correction?
See, I think the waiting game has never worked, at least is my experience. And and which is why I showed the SIP slide that if you are at a high point, maybe you may want to look at investing in a systematic format. The other point is that uh, sorry, I just missed what I wanted to say. It is slipping out of my mind. But I think the more important point is that it is not right to be totally out of this category, because as I showcased that there are many segments and many companies where it is very difficult to play just by exposing oneself to the large cap. Secondly, so I remember. So see, actually, we are seeing a broad basing of the economic growth. It is not that few segments of the economy are today doing well. It is a broad basing of the growth which is taking place, where many sectors are participating. And please remember that some of the large segments like real estate, capital goods, which has been lying low for the last 5, 10 years, these are large categories with ramifications, on the chain below. And when you think of the companies which are going to be beneficiaries because of this large capex at the top, there would be a lot of these mid caps and small cap companies which could also benefit in this whole expansion of the economy which is taking place. So I would say that take it think more long term. have your asset allocation strategy right, be balanced, and depending upon your risk profile, one can remain invested. At a high point, as I said, it is okay to come through SIP, is what I suggest.
Thanks, Vineet. A lot of questions have come on the healthcare segment, and we have a healthcare fund, which is a well diversified fund. Any thoughts on the fund and the segment as well?
So, see, actually, we were recommending the healthcare sector at a very extremely, I can say a relevant point almost 2 years back, when the sector had reached the bottom of the cycle, both in terms of their business and also in terms of the valuations. And that has hurt us in the beginning, but the last 6 months or 8 months has been pretty strong. We are seeing a lot of these companies recovering back from their lows. And the important matrix here is that the companies have seen two benefit. One, the US market pricing, which was becoming, very unproductive or unremunerative. Those price points are improving now. So because there is a shortage in US, the most of the companies have withdrawn their products because of low profit. I think this makes a good case for a cyclical recovery as far as the international markets are concerned for the Indian companies. Indian market has always sort of showed 11-12% kind of growth, which I think should sustain. And these are businesses with decent cash generation. These are businesses with decent ROEs. And in the market today, where everything in most segments are looking extremely expensive, healthcare is still maybe reasonably priced. I won't say cheap now. It was cheap 1 year back, but now it is on the reasonable side, and hence it is okay to remain invested. I think across our funds, even large cap funds, we have a high exposure into healthcare, and we are continuing, even in diversified funds, we are continuing with our decent exposure into healthcare sector.
Thanks, Vineet. The next question is, given the current valuation, a lot of money is going towards PSU stocks, or energy is the new buzzword. Your thoughts on, as a fund house, does energy make sense?
So, as I said that this is a big theme. The plans which the government has today is talking of huge capital spends which are going to take place. Uh, Beyond what the government plans, I think some of the energy spends is also linked to the external requirement, where the world is talking about energy transition. People want to move away from conventional to renewable, and then there are targets, carbon emission targets to be met. So I think this is hence a requirement which is more global in nature, and I think Indian companies will follow suit. The other important aspect to be aware about is we've had less than required investment in the past in building up new capacities, power capacities, and that is now leading to shortages. I think many of you definitely must be experiencing power cuts in many of the states and cities today. And the reason for this is that we are underinvested. The demand has gone up. We want India to become a manufacturing hub. Now, all of this will require a huge amount of power, and hence, I think the capex, which is forecastable, or the government is planning, is going to sort of create a good amount of opportunities. Now, that's on the opportunity side. The other end of the spectrum is, many of the stocks are already capturing that in a big way, and hence, while investing into these, we are following a slightly more cautious stance. We are trying to see that is there a better way to play this theme by investing into companies which could be reasonably valued, or during bad days, are we able to accumulate some of these names? So we would definitely like to participate, but we want to also be more reasonable around the valuations, is something which I wanted to highlight. On PSUs, again, I would say that there is a discernible change which has happened in case of PSUs. The government has actually created a good framework for the PSU companies where the managements there, the top managements are really rewarded on the basis of the efficiency improvement. And we have seen in case of many PSUs, there has been a marked improvement in their ROEs, in their cash flows, in their growth across different segments. So be it energy, defense, power, railways. So I would say that if these companies were to continue to showcase the efficiency improvement and sustain their strong ROEs and growth, then I would say that even for them the outlook remains positive. But here again, we keep very actively monitoring these aspects given the past what they were, just in case any factor which loosens or dilutes some of these things, we would be utmost careful. But at the moment, I think it looks pretty okay in terms of their metrics.
Thanks, Vineet. One of the other questions has come is considering that there are many upcoming sectors, probably where only a small cap can have participation. Do you have or foresee such coming in your portfolio in the DSP Small Cap Fund?
Can you, sorry, repeat?
So there are a lot of upcoming sectors which currently are only available probably through the small cap lens portfolios. So anything which you foresee upcoming or part of your small cap fund already?
So, anyways, I mean, we like participating into across the length and breadth of different segments. Let me, in the interest of time, I didn't showcase, but there is let's say these are some of the themes which we are playing through the small cap fund. Consumption, as I said, is a big theme. We and you just focus on these sub themes within the broader consumption. These are low ticket categories, discretionary categories with changing lifestyle, with rising income. Some of these categories are really going to grow big time. And we have across these pipes, tiles, wood panels, kitchenware, tableware, mattresses, luggage. A lot of these categories we have exposed ourselves, and you can see that in the portfolio we have a decent allocation to infra and the transition, climate transition, environment change which is happening. So we are capturing that as well. Manufacturing is something which is going to be a big theme that anyways is part of the overall portfolio. Within IT, we have focused on the new age businesses as well. There is an upcoming trend of artificial intelligence and the other things where we are watching that space. We are looking at companies, and if we find one, we are open to invest. So we have taken decent participation. It's a well diversified portfolio, and we are open to look at companies provided they broadly meet our framework, which we have, which I have spoken about.
And one major question which has been pertaining to a lot, how about defense? It's been part of your Tiger portfolio. Is it still a good sector to invest in? Any advice?
So we have in our mid cap fund, we have exposure to defense. Maybe today, the top company which you see in my portfolio, Bharat Forge, is also, while it is an auto, traditionally it is an auto forging company, but they have gotten into defense in a big way. Their order books have grown. In last quarter, they reported that, and they have a very strong outlook for the defense sector. So we believe that this whole shift of getting more manufacturing done in India, restricting imports of a lot of the critical components. All these are creating opportunity, and we have decent exposure. But let me again caution, the valuations are also got front-ended a bit, and it is while we would continue to own because there is momentum, but it is very difficult for us to, let's say, think of deploying new capital at any price point. We would be more reasonable, want to look at the sector into correction if there is any. Otherwise, we remain invested where we already are.
Sure. Thanks, Vineet. One last question is from Ajay Srinivasan. Why not play investor through the same mid and small cap through Flexi Cap Fund of DSP? And what is the proportion or weight of DSP Flexi Cap, which is having mid and small?
So I think FlexiCap has roughly about 50-55% large cap. The balance is in the mid and small cap. And I mean, there's no harm actually in getting to FlexiCap. For me, it is like all my babies. But and from your perspective, I think it all depends upon each investor's asset allocation strategy. I would say that if you anyways have a high allocation into mid and small cap where one is not willing to further allocate, it is okay to go with a more diversified approach, because as I said, it's a broad-based economic recovery. And I think a diversified approach for depending upon the asset allocation would also be sort of as suitable to investors. I think I'm okay with that.
Thanks, Vineet. That wraps up quite a few many questions that we have been able to take in the time constraint given. So thank you for your time. Thank you everyone for your time. I hope this 1 hour was useful to give you a brief understanding of the framework, what Vineet looks at, how the performance of mid and small cap is going to come up from here on. And we look forward to your active participation in our products, and do help us grow our business along with your investors in the rightful manner. And looking forward to more such sessions, having you on board for it. Thank you for your time. Thank you, everyone.
Thank you so much, all my investors. Thanks.